You're paying someone thousands of dollars every year to keep your money safe. But what if that very act is the single biggest risk to your financial future? I'm Tom, and this is Tom Thinks. I'm here to cut through the Wall Street jargon and give you the real talk on your money, even if it hurts your feelings a little bit. If you're someone who's ever wondered why your portfolio isn't growing despite paying for professional advice, or if you felt that nagging suspicion that maybe, just maybe, your financial advisor doesn't have your best interests at heart, hit subscribe and give this video a thumbs up. The safety illusion. Look, here's the thing about so-called safe investing that nobody wants to talk about. We've been conditioned to believe that if we just hand our money over to a professional, someone with a fancy title and a nice office, that our financial future is secure. It's the ultimate comfort blanket. But what if I told you that this comfort is actually an illusion? What if the very system designed to protect your wealth is structurally designed to prioritize its own survival over yours? Now, I know what you're thinking, Tom, that's a bit dramatic. My advisor seems like a nice person, and you're probably right. Most financial advisors are decent people trying to make a living. But here's what most people don't realize. The title financial advisors is about as meaningful as the word natural on a food label. It's a marketing term, not a professional designation. According to industry insiders, the following people can all legally call themselves financial advisors: your CPA, your divorce attorney, an insurance salesman, an investment consultant, even a broker. It's a role, not a job with standardized qualifications. This is where it gets interesting. The barrier to entry is embarrassingly low. To become a financial advisor, you typically need to pass some basic exams that focus more on understanding regulatory rules and the products you're allowed to sell than on actual financial wisdom. We're talking about a few weeks of study for exams that literally don't require you to know anything about comprehensive financial planning. Think about that for a second. We have higher standards for someone cutting our hair than for someone managing our life savings. You wouldn't want a hospital to differentiate itself by saying, "Our doctors actually went to medical school." That should be the expectation. Yet in financial advice, having actual credentials is often treated as a premium feature, not a basic requirement. This creates what I call the competence lottery. You might get someone brilliant who genuinely cares about your future. Or you might get someone who passed a test 3 weeks ago and is now being told to sell high commission products to their friends and family. And statistically, the odds aren't in your favor. 95% of people who enter financial advisor development programs at major firms like Merrill Lynch and Morgan Stanley fail out. They waste 1 to 3 years gaining no transferable business skills, often accruing debt instead of savings. Business model is fundamentally broken, and you, the client, are the one funding that broken system with your hard-earned money. The compensation trap. Now let's talk about how this broken system actually makes money, because this is where the rubber meets the road. Most people have no idea how their financial advisor gets paid, and that's by design. Here's the brutal math that recruiters won't tell recent graduates. In a typical development program at a major firm, the house takes around 80% of your production. Let me make that real for you. If you want to make $50,000, that's the average starting salary for a recent graduate, and you charge 1.5% with a take-home of 0.3% after the firm takes its cut, you would need $16.7 million in assets under management. $16.7 million. Just to make $50,000. To make $100,000? You need over $33 million in assets. Now, think about what that means for you as a client. Your advisor, especially if they're early in their career, is under immense pressure to gather assets. Their survival depends on it. This creates what behavioral economists call motivated reasoning. When someone's paycheck depends on them not understanding something, they'll find a way not to understand it. When an advisor's livelihood depends on convincing you to move your money to their firm, how objective do you think their advice will be about whether you should stay with your current investments? This compensation structure explains why so much of financial advising has become about gathering assets rather than providing genuine advice. The junior advisor trainee, and make no mistake, at firms like Morgan Stanley, Edward Jones, or Merrill Lynch, they will only refer to you as a trainee, isn't given the freedom to actually manage money. They're limited to house portfolios. The last thing these firms want is a bunch of recent graduates playing portfolio manager and causing big losses for clients. That's too much liability and they don't trust you enough. So what do these trainees do? They become salespeople. They're not analyzing markets or building sophisticated financial plans. They're making cold calls, trying to convince people to move their retirement accounts. And here's the psychological twist. Because they're calling themselves financial advisors. Both they and their clients believe they're engaging in financial planning, but really it's asset gathering disguised as advice. This is why the industry has such a high failure rate. It's not that these people aren't smart or capable. It's that the business model requires them to become salespeople overnight, often with no sales training, no existing network, and no real value to offer beyond access to the firm's generic investment products. The product sales game. Moving on to the actual products being sold under the guise of safe investing. This is where the story gets really dark. Remember earlier when I said financial advisors aren't stockbrokers like in the movies? That's true, but not in the way you might hope. In a world where you can download over 10 different brokerage apps and place free stock and options trades from your cell phone, there's no economic reason for anyone to pay commissions for stock trades anymore. That business model died. So what replaced it? Structured products, insurance contracts, annuities, private placements. These are the modern equivalents of the hot stock tips of the 90s, but they're wrapped in complexity that makes them seem sophisticated and safe. Let me give you a concrete example from recent history. There are law firms right now specializing in helping investors recover losses from oil, gas, and energy investments. Why? Because brokers and financial advisors touted these as safe, reliable investments producing significant income with little to no risk. Thousands of investors, many of them seniors interested in generating retirement income, believed these misrepresentations. Recently, these investments suffered catastrophic declines in value and proved to be far riskier than described. Many investors lost their hard-earned life savings while their brokers earned substantial commissions. One firm alone has recovered over $4 billion for clients who were misled. Now, here's what most people don't realize about this dynamic. The advisor isn't necessarily evil. They're often just as much a victim of the system as you are. They're given talking points by their firm. They're told these products are safe for conservative investors. They're shown historical returns that look impressive, and they're paid handsomely for selling them. This creates what psychologists call commission blindness. When someone stands to make $5,000 for selling you a product versus $500 for giving you good advice that doesn't involve a product sale, human nature kicks in. We find ways to justify the more lucrative path. We tell ourselves, well, the client does need some fixed income exposure, or this product does provide guaranteed income. We emphasize the benefits and minimize the risks. This isn't malice. It's the system working exactly as designed. The regulatory framework for financial advice is fundamentally flawed because it regulates what gets implemented at the end of the advice process, not the advice itself. If an advisor implements insurance, they need an insurance license. If they implement a commission-based investment, they need a brokerage license. The advice itself? That's largely unregulated. Anyone can call themselves a financial advisor and give you terrible advice, as long as they don't implement a regulated product at the end. That's their fear. It's like being able to give medical advice without a license, as long as you don't actually write a prescription. The system is designed to protect the sales process, not the consumer. The technology disruption myth. Now, you might be thinking, but Tom, what about all the technology that's supposed to fix this? Robo-advisors, AI, all that stuff? Here's where it gets really interesting. For decades, people have been predicting that technology would kill the financial advisor. Back in the 1970s, when stock trading commissions were deregulated, startups like Charles Schwab emerged with computers that could trade stocks cheaper than humans. The idea was to obliterate the human financial advisor with technology. And in a way, the robots won. Stock trading costs fell by 90% in 20 years. Today, most stock and ETF trading is commission-free. But technology didn't kill financial advisors. It just killed their existing business model. So, what happened? Financial advice adapted by moving up the value chain. No longer could advisors make money just by executing trades, so they started selling mutual funds instead. Then the internet came along and suddenly you could research and buy mutual funds online. So, advisors moved up again, this time to asset allocation and diversification. Then robo-advisors showed up offering diversified portfolios at a fraction of the cost. So advisors moved up again, this time to holistic financial planning, tax advice, estate planning, retirement planning, insurance. Every time technology advances, advisors respond by moving further up the value chain. And here's the psychological insight that explains why this keeps happening. Michael Kitces, one of the industry's leading experts, calls it the AI penalty. Imagine you hail an Uber and when it shows up, there's nobody in the driver's seat. It's a driverless car. Would you get in? Broad consumer data suggests most of us wouldn't. Part of it is questions about the technology. Is it really that good? But there's also this weird effect from autonomy and control dynamics. We as human beings don't like being in situations where we're not in control, especially when the stakes are high. We don't mind our cars giving us warnings when someone slows down in front of us. We don't even mind if it hits the brakes faster than we could. But relinquishing full control? We prefer another human to have their hands on the wheel. Eventually, we might get comfortable with driverless cars, but then another problem arises. Now, there are 17 different AI driverless cars, and you have to figure out which one is actually safe. 16 might be good, but the 17th will kill you. Are you sure you're getting into a safe one? How have you vetted it? This exact same dynamic applies to financial advice. The do-it-yourselfers will figure out how to use the new technology, but most people would rather hire a human they trust than have to become experts themselves. Human accountability is a bigger driver of change in our behaviors than any technology. It's the friend you agree to jog with at 7 a.m. because you don't want to leave them standing alone. That human dynamic is why financial advisors survive every technological disruption. The unstable reality. But here's the problem with relying on human advisors in today's environment. We're not living in normal economic times. According to the latest 2026 outlook from major research firms, we're not in an uncertain environment, we're in an unstable one. Let me explain the difference, because this matters for your so-called safe investments. Uncertainty implies a lack of clarity. We don't know what's going to happen with elections, wars, or Federal Reserve decisions. But uncertain environments still allow for probability models. Unstable environments are different. Unstable implies movement, with shifting inputs and relationships happening in real time. The economy isn't just unclear, it's fluctuating. The relationships between different economic variables are changing as we watch. This creates what economists call a K-shaped economy. Some parts of the economy are doing great while others are struggling. Big companies with over 500 employees continue to hire aggressively, while small businesses with 20 to 49 employees have seen net job losses. Profit margins are diverging by company size. Housing supply is frozen by mortgage rate lock-ins. Labor supply is altered by immigration shifts. We're operating on multiple economic paths at once. Now, here's why this matters for your safe investments. Traditional financial advice assumes a certain stability in the system. It assumes that diversification across asset classes will protect you. It assumes that bonds will zig when stocks zag. But in an unstable K-shaped environment, these relationships break down. Inflation isn't behaving normally either. The Personal Consumption Expenditures Price Index has been above the Federal Reserve's 2% target for 4.5 years. Price levels remain egregiously above where they were before the pandemic. Tariffs have raised overall retail prices by nearly 5 percentage points. And, get this, 40% of the items in the Consumer Price Index are now calculated using estimates because the Bureau of Labor Statistics doesn't have the resources to collect actual price data. We're flying partially blind. In this environment, what passes for safe in a financial advisor's playbook might actually be quite risky. The standard 60-40 portfolio might not work when stocks and bonds are both getting hammered by inflation. The safe bond ladder might get decimated by unexpected rate moves. The conservative allocation to value stocks might underperform for another decade while growth stocks soar. The problem isn't that advisors are intentionally misleading you. The problem is that they're often working with models and assumptions built for a different economic era. They're trying to apply stable world solutions to an unstable world problem, taking back control. So, where does this leave us? If the traditional system is broken, the compensation creates conflicts, the products are often missold, technology hasn't fixed it, and we're in an unstable economic environment, what should you actually do? First, recognize that true safety in investing doesn't come from outsourcing your thinking to someone else. It comes from understanding enough to ask the right questions. You don't need to become a financial expert, but you do need to become financially literate enough to spot when someone's selling you something versus advising you. Second, if you do work with an advisor, understand exactly how they get paid. Are they fee only, meaning they only get paid by you? Or are they receiving commissions from product manufacturers? Ask them to put their compensation in writing. Ask them to explain in simple terms how much they make if you follow their advice versus if you don't. Third, recognize that in an unstable K-shaped economy, traditional diversification might not be enough. You need to think about diversification across economic exposures, not just asset classes. What happens to your portfolio if inflation stays sticky around 3% instead of going back to 2%? What happens if tariffs remain high for another 5 years? What happens if AI creates massive productivity gains but also massive labor displacement? Fourth, understand that the greatest value a good financial advisor provides isn't investment picking, it's behavioral coaching. Data is clear that the biggest mistakes investors make are behavioral. We sell at the bottom out of fear. We buy at the top out of greed. We chase performance. A good advisor's real value is talking you off the ledge during market crashes and keeping you from getting too excited during bubbles. But here's the key insight. You can get this behavioral coaching without paying 1% of your assets every year. You can join an investment club. You can find an accountability partner. You can use technology to automate your investing so emotions don't interfere. Finally, and most importantly, recognize that true financial safety doesn't come from finding the perfect investment or the perfect advisor. It comes from building multiple streams of income, keeping your expenses low, avoiding debt, and having enough cash reserves to weather storms without having to sell investments at the wrong time. The financial industry wants you to believe that investing is complicated so they can justify their fees. But the fundamentals are simple. Spend less than you earn, invest the difference in low-cost diversified funds, avoid debt, and be patient. The system makes this seem boring because boring doesn't generate commissions, but boring is what actually builds wealth over time. Your financial future is too important to outsource to someone whose incentives might not align with yours. Take back control. Ask the hard questions. And remember, in a world where everyone is trying to sell you something, the most valuable skill you can develop is the ability to think for yourself.
Found this interesting? Subscribe to the channel. Give this video a like, share it out, and drop your questions or ideas in the comments. Until our next adventure.